Good morning. It's Jeffrey Christian of CPM Group. It's about 10:40 in the morning on Friday, the 17th of January, uh, here in New York, where we are. I want to talk about the outlook for gold, silver, platinum, and palladium. But first, I want to talk about the economic outlook some, because it's obviously very important and very much a topic. These are CPM Group's current 10-year projections for global economic activity, real GDP. The dotted line are the divisions between the actual historic data and our 10-year projections. We have been predicting a recession for 24, 25, 26. It didn't occur in 2024. Economic conditions in the United States and several other countries were much stronger than everybody, including CPM Group, pretty much expected. We're still expecting a recession. We're in the process today and next week of updating our economic projections for the next 10 years. And we're having a real difficulty because there's so much uncertainties. And I've said it in recent videos, and I'll say it again. Our view is that the political and economic uncertainties today are probably greater than they have been at any time since 1941, before the United States entered World War II. Um, we have enormous uncertainties as to what the incoming Trump administration will do, what would it try to do, what it can succeed in doing, what other groups and power centers and actors, including the U.S. Congress, which is Republican controlled, but is somewhat distinct from the Trump administration, and foreign governments, foreign entities, large corporations. There's so many uncertainties as to what these different economic and political actors will do that it's very hard. And right now, we're sort of thinking that we'll keep our projections such as they are, but textually discuss these uncertainties and what they could mean. Now, the stronger economic conditions, and I'll talk about reconstruction programs in a second, could make a recession smaller or later, can obviate a recession in 2025, 2026. But our view is that there's no such thing as a soft landing. A soft landing is an extended period between recessions. You saw that, if you will, as a soft landing between, say, 2011 and 2019, where you had subpar growth. Well, it was actually pretty good growth, but it wasn't like the peaks years that you saw in the early aughties, or in the immediate aftermath of the Great Recession. You saw steady growth for an extended period of time. And we've, in fact, seen this several times now since 1983, uh, whereas from World War II to 1983, you would see a recession every 4 to 6 years. From 1983 until 2010, you saw a recession roughly every 10 years. So you had extended periods of what some people would have called soft landings. We simply called them extended periods of expansion between recessions. We do see a recession coming, but the reality is that the stronger economic conditions and reconstruction programs could delay a recession and make it smaller. So that's something to pay attention to as we go forward. Those economic uncertainties are enormous, however, and they could, in fact, bring the recession closer and make it deeper. If you had 30% tariffs on goods and services coming into the United States from Canada, Mexico, China, you have blanket tariffs on other countries, you could see a sharp decline because, quite frankly, one of our major imports is auto parts. Another one is electronic parts. Another one are components to go into solar panels, for example. And most of those companies that manufacture those goods work on a just-in-time inventories. So you have tariffs, you have counter tariffs, you have a trade war emerging. You could see the major industries in the United States shut down in very short order. We even import wood, which is kind of silly. I want to make another point because you hear gold bugs and anti-government demagogues talk about de-dollarization, and we're really not seeing that. We have seen central banks reduce their dollar reserves over the last 6 months, 12 months. That is because they're using their foreign exchange reserves, which are 60% roughly, 58 to 62, maybe it's down to 57% as of November. They use their foreign exchange reserves, primarily US dollars, to shore up their economies. And the economic environment going into 2024 and into the first half of 2024 was extremely bad. You had recessions appearing in some European countries. You had problems in the United States, Canada, China, Russia, India. You had slow growth, and you were teetering on the brink of falling over into a recession. And central banks use their monetary reserves, i.e., US dollars, to help shore up their economies. In addition to that, the dollar was rising sharply. So when you start saying, well, what currencies in my reserves do I want to use? The dollar was the strong one. That's what you wanted to use. And when you looked at your mix of currencies, 60% in the dollar, 19% or so in euros, 10% in yen and British pound sterling, and another 12% or so in other currencies, the dollar was the strong one. You were taking profits of a dollar that was rising sharply, even as all the demagogues were telling you that the dollar was going to collapse. So de-dollarization is a joke. It's a myth. It's one of those conspiracy theories that don't hold up to economic scrutiny. If you actually talk to central banks or read what they write in their quarterly and monthly reports, you see they were using their dollars to shore up their economy, and they were cashing in on a dollar which was very sharply higher than it had been 2 years earlier, 1 year earlier, and 5 years earlier. So if somebody starts talking to you about de-dollarization, try to sell them a pet rock. I want to look at this chart. I blocked out this period from 1971 into 1978. And you can see we had a very sharp and deep recession. It started in late 1973, and it actually ran into 1975. We had the Yom Kippur War start in October of 1973. OAPEC started an oil embargo against shipping OAPEC oil into the United States, Europe, and Japan. That threw the world into a very deep recession. This is U.S. GDP, and you can see a prolonged recession. I'm familiar with it because in late 1973, a little personal history, they ended the draft, and I took a year off of college. I was going to work as a carpenter and play in a rock and roll band. And when we went into that recession, finding carpentry jobs was very difficult. But in the first half of 1974, there were a series of really disastrous storms across much of the United States. Hailstorms were very typical at that time, and they damaged hundreds of thousands, if not millions, of cars that had to be replaced under insurance policies. And they damaged a number of millions of houses nationwide. Roofs, if you had aluminum siding, it was destroyed by the hail. If you had aluminum gutters, it was destroyed by the hail. If you had an aluminum patio roof, it was destroyed by it. And one Sunday, I got a call from a company I had applied to be a carpenter. I'd been doing odd jobs in carpentry, freelance carpentry. When I got a call on a Sunday morning saying, "Hey, you want that job? Come on in Monday morning, 7 o'clock. Let's start." And what you saw in 1974-75 was that the reconstruction from those natural disasters actually helped mitigate the recession some and speed the economic recovery. Today, we have the LA fires. In the fourth quarter of last year, we had the hurricanes that ravaged large portions of Southeast Asia. You're going to have perhaps a ceasefire in Gaza and reconstruction. You know, the Kushner organization wants to build luxury vacation condominiums along the shore in Gaza. That's probably not going to happen. But there's going to be reconstruction in Gaza. There's going to be reconstruction in Ukraine. You have had a number of natural disasters in South Asia and in Southeast Asia. And all of those things, many of them are covered either by insurance or government programs that will rebuild. And that reconstruction from both natural and man-made disasters could mitigate contractionary conditions in all of our economies and delay or soften any recession that we might have. So those are things that you really need to pay attention to, on an economic basis. In addition to that, you could see today the Fed released its U.S. data for December industrial production and capacity utilization. And industrial production data for December was very healthy across the board. So we've seen good recovery in November and in December in business equipment production, which is a leading indicator of other economic activities. When companies start buying business equipment, that means they're expanding, and that means they're hiring people, and those people then have the money to buy a car or buy a house or remodel their house or buy new appliances for their house. So business equipment expenditures and industrial production in business equipment is a good leading indicator. We have a lot of strength going into 2025 economically. And as I've also pointed out earlier, if you look at past recessions, we've had pretty strong growth prior to the recession, onset of a recession. We sometimes slide into a recession, but more often than not, we fall into a recession from a period of strong growth. So the fact that we've had stronger than expected economic activity over the last couple years and going into 2025 is not anything that precludes the idea that you could go into a recession. That stronger growth stresses certain economic realities. And then on top of that, you have the change in administration in the United States. You have no idea what's going to happen with spending. They're talking about cutting $1 or $2 trillion from government spending. The CBO, the Congressional Budget Office, which is this nonpartisan economic research group, looks at what they're talking about and says, actually, we think that they're going to wind up increasing spending, government spending, and increasing deficits and raising the debt amount in that the United States government owns more rapidly than otherwise would be the case. It remains to be seen. Tremendous uncertainty. And when things are uncertain, people do things, several things. Companies slow down their business equipment orders and expansion plans. They become more cautious. Consumers become more cautious, and investors buy gold and silver and U.S. Treasuries. Let's turn to precious metals. Gold prices have risen sharply since 18th, 19th of December. They're still in this consolidation range that they got into after the end of October. We're testing that. We tested $2,800 this week. Prices are off a little bit now. I think gold is $2,742 an ounce for the February COMEX contract as we started making this video. Prices are testing the upper end of that range. CPM Group has been saying that we expected gold prices and silver prices to rise in the first quarter of this year after this consolidation period ends. we could be seeing the end of that consolidation period, and we could see higher gold prices. Over the next 2 weeks, we'll see the February COMEX contract become deliverable at the end of January. And one of the things that we've seen is there's tightness in the supply. You're seeing the February contracts already roll over into April. That roll will apply some pressure, upward pressure on prices over the next 2 weeks. By the beginning of February, we expect the roll to be over, and that could see some price weakness. Also, depending on what happens after Mr. Trump's inauguration on Monday, we could see some price weakness or we could see some price strength. So there's a lot of uncertainty and a lot of questions and a lot of volatility there. But CPM Group has been expecting higher prices in the first quarter, and we still expect that. We expect this consolidation phase to end, and it may well be in the final stages, and we may see a breakout as early as next week to the upside. We did issue buy recommendations on gold and silver and platinum and palladium on Tuesday to our clients who pay for these ultra short-term trade recommendations. And then we reinforced our gold and silver buy recommendations on Thursday of this week. It's starting to look like the consolidation period is ending. Silver prices also continue to consolidate. They also have moved into that higher end of that range. You can see we did see a spike up in December, in December up to about $33 an ounce. Again, this is for the nearby active, which would be the March contract on COMEX right now. Our expectation is that prices will rise, and we may be seeing the end of this consolidation phase, leading to stronger prices over the course of the first quarter. Now, I'm going to repeat some stuff talking about the arbitrage. And the most important thing to understand is that arbitrages happen across commodities, and they happen in gold and silver. And right now, we're seeing a situation that started with some increased demand in tight markets for gold and silver in the United States. And that started to increase the spread between prices in London and prices in New York. As that spread increased, the arbitrage opportunities increased. It caused some stress on some banks that had played that spread, expecting it to remain in its typical range. As the spread widened, speculators came in. On top of that, the president-elect and his minions started talking about these massive tariffs. And there were people who started spreading rumors that the tariffs would also apply to gold and silver. It's all unknown because, as Mr. Trump said himself, he just throws those numbers out to scare people so that they'll negotiate to his advantage. It's completely unknown what's going to happen with those tariffs. But you started to see promoters saying, oh, there's going to be tariffs, high tariffs on gold and silver, as well as everything else coming into the United States. You've got a tight gold and silver markets in the United States already. This is going to blow out, and the prices are going to, silver will be $1,000 by May. You started seeing all that nonsense that we saw with the Wall Street silver squeeze, the world's running out of silver. And you started to hear people say, oh, London's going to run out of silver to ship to the New York market. Now, the way markets work, there's an arbitrage. There's a spread between London and New York. And when that spread is great enough that New York is higher than London prices, people will buy gold or silver in London and ship it to New York. And when the London price is high enough to cover those transportation costs, they'll buy metal in New York and ship it back to London. And we've seen it go both ways over and over again throughout history. Yeah, I can go back to stories in 1907 with that arbitrage being done. And that was at a time when I guess people used telegraphs to communicate between the New York and London markets, right? That's how arbitrages and markets work. And it's not just gold and silver, that's how markets work. When you have a spread that covers the transportation costs and mechanical costs, you see it. You saw this in previous times, including in the second quarter of 2020, after the world economy was locked down to try to limit the deaths that were caused by the COVID pandemic. If London runs low on silver, it's not going to run out of silver. If London runs low on silver, the London price will rise. It will rise sufficiently that silver will be shipped to London. Yeah, it's not the end of the silver market as we know it. It's the silver market behaving the way it always does. So it's not particularly surprising. Throw in something else that's being kicked around. In 1979 and early January 1980, the COMEX, the CME, the Chicago Board of Trade did not change the rules. They imposed the rules. The rules were on the book all along that said if there's a massive market dislocation, the various committees and boards in the various exchanges had the right to take such steps as were they deemed necessary to keep the markets operating in an efficient fashion. Those rules are on the book. And the fact that certain people didn't know that or didn't pay attention to that was their problem. But when people say that the rules were changed, they're speaking incorrectly. The rules were not changed, they were imposed. They were there in 1979, and they're there in 2025. So words matter. Have to be careful. So going to arbitrage, again, I'm going to show you some charts that we used earlier in the week, and they're still important. These are eligible and registered stocks, registered and reported to the COMEX in New York. You can see there's about 300 million ounces of total silver that is deliverable to COMEX in COMEX registered depositories. There are other depositories in the New York area and across the country that have even larger amounts of silver that aren't reported because they're not in the COMEX capture area, right? But that 300 million ounces, yes, it's down from 400 million ounces where it spiked up in that second quarter of 2020 during the COVID lockdown. And you saw COMEX inventories, oil inventories in West Texas, in Cushing. You saw inventories of all kinds of commodities spike up because of the economic lockdown, right? So you have that spike up. You take that spike out, and COMEX inventories, eligible and registered, are at record levels. You look at where COMEX registered stocks are, and they're as high as they were in 2007, 2008, which was at a time when the price of silver was about $5, $6 an ounce, and a lot of investors were still disenchanted with silver. So you still have ample amounts of silver in New York, and you have about 830 million ounces of silver in London. And it looks dire because, again, you saw this big increase 2017, 2018, and then high levels of silver in that 19 to 20 level. You can see the spike down, which was much larger than the spike down we have now in 2019, 2020. That's that arbitrage opportunity in the second quarter of 2020. And then it came right back up. And since that time, it's declined. But, a better way to understand silver inventories in London is to put the scale 0 to 1,200, 1.2 billion ounces. And then you can see, yes, Inventories are way down from where they were from 2017 to 2021, but there's still more than 800 million ounces of metal in London LBMA registered depositories, not counting all the silver that isn't good delivery, and not counting all the silver that is not in the LBMA registered depositories within London, and not counting the silver that's held outside of London or on the continent or any place else. And Shanghai inventories, I don't have the chart, also are up. Turning to platinum and palladium, while we are positive on our price outlook for gold and silver this year, we continue to say that platinum and palladium prices will be weak. Now, they've fallen sharply. I have, on the left-hand side, there is a price since January of 2024, last year, and you can see it's largely moved sideways. And then on the other side, I have the prices since 2015. I should have had put in a chart going back to 2008 when platinum prices were $2,000 an ounce. They fell from $2,000 an ounce to $800 an ounce by 2016, and they basically moved sideways since then. There was a spike down to less than $600, and there was a spike up to $1,300. But we're basically in this channel, and our expectation is that channel continues for the next year or two, and then you might see even lower platinum prices. So we're not encouraging investors to buy platinum at this point. And the same is true with palladium. Although palladium prices did rise sharply from 2017 through 2022, spiking up when Russia invaded Ukraine, they have come back down. They're not down to pre-2017 levels. There are political risks there, but you can see since the beginning of last year, palladium has been moving sideways in its channel. Our expectation is that it will continue to do that. That's our view on a short-term basis on the world economy, the U.S. economy, the economic environment that affects investment demand as well as fabrication demand for gold, silver, platinum, palladium, and our outlook for gold, silver, platinum, palladium. We will be coming out with our yearbooks in March, May, and July. You may pre-order them at our website. We'll be doing our Silver Facts and Fantasies online seminar at the end of February, and we are talking about a silver seminar in the fourth quarter of this year. You may always go to our website, cpmgroup.com. There are free reads, there are free videos, there are free presentations and reports. You can send us an email, and you can also order our yearbooks and pre-order our 2025 yearbooks and subscribe to our Precious Metals Advisory and look at various other programs that we have, including our Retail Investor Program, which is a stripped-down version for retail investors of the more intense work that we do, like the Precious Metals Advisory, for larger institutional investors, mining companies, fabricators, and others. Most of our business is with companies that either produce, consume, or invest in commodities. Our biggest source of revenue are investors, mostly institutional, high net worth individual investors, family offices, and a full range of institutions, including some of the largest sovereign wealth funds in the world. We help companies that have and individual investors that have exposure to commodities to manage that price exposure in a more efficient and profitable, hopefully profitable way. You can always send us an email at info@cpmgroup.com saying, I'd like to talk to you about ways that CPM Group can help me. That's all I have for now. I've gone a long time. Sorry about that. Take care of yourself. Take care of those around you. Try to do something good for the world. And we'll talk to you next week. Our next video will be under the guise of a new presidency in the United States. Take care.